Okay, hi everyone. It's Jefford again from Rubik's Academy. It's a pleasure to meet all of you again, meet all of you again. Today we are here going through one of the most important concepts as a trader. It is a concept that will apply whether you're into trading FX, whether you're into trading shares, whether you're into trading options, futures, commodities, REITs. As long as you're into trading, this concept will apply. This concept will apply. All right, and that is the concept of reward to risk ratio or risk to reward ratio, whichever. Different people use different terms. All right, but they all mean the same thing. All right, or we sometimes call it the triple R, RR, right? Because risk to reward ratio is R as well, so triple R. Now, the triple R is an extremely important indicator for any trader because not all of us have 50, not all of us have 100,000, a few hundred thousand, or even a few million to trade the market. Therefore, before we go into the market, we need to make sure that every trade we go into has maximum upside and minimum downside. All right, that's basically what risk to reward means, or reward to risk means. The ratio of your upside to your downside. Okay, you need to always make sure that the upside is definitely more than the downside for every trade, so that you can maximize the amount of money you can make from each trade. And in that sense, you accelerate the growth of your portfolio. If you're getting into trades just because it's a good trade, because you think you can make money without looking at the risk to reward ratio, I guarantee you that in the long run, you will not see a profitable portfolio. You will not see a profitable portfolio. All right, so let's get into the heart of things. Let's start with today's lesson: risk to reward ratio or reward to risk ratio. All right. Okay, so over here I have with me a chart. Okay, so let me just delete this. Now this is Delta Airlines. Okay, this is Delta Airlines. You can see I'm looking at a lot of stocks. All right, if you know some of these stocks, it's good for you, but they're all airlines. All right, so this is Delta Airlines. It is the biggest aviation stock on NYSE, possibly also one of the biggest market capitalization. Berkshire Hathaway recently sold some of its shares for Delta Airlines, but still it remains the biggest aviator for America, doing both domestic and international flights, if I'm not wrong. All right, but the reason I picked this share is because it's a very common stock. As long as you're trading shares, you should be able to gain access to Delta Airlines chart. Now, today we're going to use a very simple method to find out the risk to reward ratio. All right. Now, first of all, when you get a chart like that, the first thing you want to do is draw the support and resistance levels. In this case, let's draw the support levels first. Okay. So let's say I put my support around here. All right, 20.78. Let me put it in light blue color. So that is my support level. A support level is where prices tend to bounce up when it touches that level. That's why it's called support. It's like the floor of a room. Okay, when you bounce a ball onto the floor of a room, it bounces back up. So imagine the ball are prices, and the floor itself is the support level. Now, the next thing you want to draw is the resistance level. Okay, so resistance level is around here. Let me put that in orange. Okay, so you have the support level, you have the resistance level. Resistance level is like the ceiling of the room. When the ball bounces up and touches the ceiling, it is inclined to come back down. All right, it's not a guaranteed for sure thing that it will come back down, but it tends to come back down. Okay, so let's say we have the support and resistance levels. Now, the next thing you want to do is, let's assume that the price came down. All right, the price came down to this level. Let me put that in white color. So the prices came down to this white rectangular box. And once it comes down, okay, into this range, your estimate is that it will bounce back up, right? You're expecting prices to bounce off the support level. So it should bounce back up. All right. Now, so if you're expecting prices to bounce back up, what will you do? You will start to go long on this trade. Go long means you start to buy. Buy and long, they are synonymous in the world of finance. Okay. So let's say you go long. Now, where will you put your stop loss? Your stop loss is where if you are going long, your stop loss will be below your entry price level. If you're going short, that means you're selling, your stop loss will be above your entry price level. So your stop loss could be somewhere around here. Maybe somewhere around here. Okay, let's put that in pink. Okay, so the pink line at $20 is your stop loss, meaning that if you went to buy the stock at 20.78, you were wrong. The price continued to go through the floor, go through the support level, break down below. When it touches $20, your trade will be stopped out. It will automatically be gone. Okay, it could be via auto execution or manual execution. It's up to your broker. No matter what, $20 is where you exit the trade. You're wrong, you exit the trade. But let's say, if you're right, prices did bounce back up upon touching the white rectangular box. Now, what will you do? You would now try and find a take profit level, and the take profit level could be somewhere around here. Because your take profit level should be below your resistance, right? Because you're expecting prices to bounce down again upon touching the resistance level. So you should put it below the resistance. Now, so the resistance is around 25.54. You put it somewhere below 25.54, you put it at 25.21, that is your take profit level. Now, for every dollar that you stand to make in this trade, how many dollars do you stand to lose? Okay, now let's find out. So let's say we look at the amount of losses that you can make first. Okay, let me put it in red. The red box, okay, the red box is where you stand to lose. That is your loss terrain. That is the amount of margin that you stand to lose. That is your potential loss margin, your PLM right there, the red color rectangular box. Okay, how much do you stand to make? Your green color. Let me put that in green. Okay, the green box is how much is the amount of margin that you have to make from this trade. Okay? Okay, so you can see that the red box is a lot smaller than the green box. Okay, you don't have to do this for all your trades, but this is just an illustration. You can see that the red box is a lot smaller than your green box. What does that mean? It means that for every dollar that you stand to lose, you stand to make a lot more dollars. All right. Now let's put that into mathematical terms. Okay, let's put that into mathematical terms. All right. Okay, so how do you find out the exact risk to reward ratio or the reward to risk ratio? Very simple. You take the entry price, which is 20.78, you minus away your stop up level, your stop loss level, which is 20. And then you get 0.78. You get 0.78. So that is the amount of losses that you can have per share. All right. Now, how much do you stand to make per share? So very simple. You take your entry level, minus away your potential take profit level. minus 4.43. Okay, now it says minus, but you should take it in absolute terms, which means it's 4.43. So 4.43 divided by 0.78, you're looking at 5.679. In other words, okay, again, 5.679 is how much is the ratio. It is the reward to risk ratio. The reward to risk ratio is 5.679, or to round it to a round number, 5. So in other words, your reward to risk ratio is 5:1. For every $1 you stand to lose in this trade, you stand to make $5. And that, to me and to any trader, it should be a very good and healthy reward to risk ratio. So next, you're going to ask me, what is a good reward to risk ratio? Now, in a book written by Victor Sperando, all right, I think he's Italian. He was a trader at Lehman Brothers way before the crisis, top trader, made a lot of money. In his book, all right, he said that a good reward to risk ratio is 3:1. Now, for me, personally speaking, because the accuracy of my trades are not bad, all right, it's passable, it's good, I would settle for 2:1, at least 2:1. You should never go below 2. I repeat, you should never go below 2. All right, so that is it for this video. All right, rewatch the video again if you have to understand, because this, I repeat, this is a very, very important concept that you need to know as a trader. Everybody who wants to trade needs to know this. Essential, okay? So you need to know this, all right? And you definitely are going to use it for the rest of your financial instruments as well. All right, so if you like this video, give this video a like, follow us on Rubik's Academy, follow us on our Instagram page, follow us on our LinkedIn page. Rubik's, spelled with an E, REUBIKS Academy. All right, thank you very much. See you next time.